Welcome to the Deep Dive. This is where we take a whole stack of information, kind of sift through all the noise, and pull out those really critical nuggets of knowledge.
Yeah, giving you that shortcut to being genuinely well-informed.
Exactly. And today, we're peeling back the layers on, well, one of the most talked about moves in finance recently. Really insightful, actually.
Definitely got people talking.
Our mission for this deep dive is basically to unpack a recent decision by, the legend himself, Warren Buffett. It really sent ripples, maybe more like surges across Wall Street.
Yeah, quite the reaction.
We're talking about his significant investment in UnitedHealth Group. So we're going to explore why this particular purchase is being called a classic Buffett move.
Right.
What it tells us about value investing, especially, in today's volatile market.
Which is key right now.
And maybe what it signals for the broader healthcare sector, which, let's face it, is often kind of misunderstood.
That's true.
We'll be drawing from market analysis, some commentary from seasoned Buffett watchers, and of course, a close look at UnitedHealth's own recent performance. Get the full picture.
And what's really fascinating here, I think, is how this single investment, by one of the world's most successful investors, it just illuminates these fundamental principles of investing, especially when the market gets caught up in a particular story, maybe a fear narrative.
Yeah, the herd mentality.
Exactly. So we'll connect the dots, look at the corporate challenges, the market sentiment, and that unwavering long-term view that really defines investors like Buffett.
It's that whole temporary setbacks versus permanent damage thing he talks about.
Precisely. Discerning between the two is, well, everything.
Okay, so let's dig in. To really get why Buffett's move was so significant, we first need to understand the scene, right? The landscape he was stepping into.
Yeah, context is crucial.
Before Berkshire Hathaway made its play, UnitedHealth Group, this is a healthcare giant, a household name.
A Dow component for over a decade.
Exactly, 13 years. It was, and this is a quote from one source, pretty much abandoned by Wall Street.
Abandoned. That's a strong word for a company that size.
It sounds almost unthinkable, doesn't it? For a company of that stature to be so, shunned. So you might be asking, why?
Yeah, what happened?
What could possibly lead to such a dramatic, almost sudden shift in sentiment around a blue-chip company like that? It's not every day a pillar of the economy faces that kind of rejection.
No, it's not. And you might be wondering then, what specifically spooked investors? What caused this mass exodus from UnitedHealth's stock?
Right.
Our sources paint a pretty clear picture. Maybe unsettling, but clear. It was multiple headwinds kind of compounding.
Not just one thing, then.
No, not at all. It was more like a cascade, creating what a lot of observers called a perfect storm of bad news.
Okay, so what was first?
First, and probably the most immediate hit for a health insurer, was a surprise surge in medical costs.
Okay, that made sense.
Yeah, imagine you're UnitedHealth. Your whole business model relies on predicting and managing healthcare costs, right? Suddenly, bam. Unexpectedly higher payouts. Some sources said it was partly due to people finally getting those elective procedures.
Stuff deferred during the pandemic.
Exactly. Deferred care catching up.
Yeah.
So costs mounted fast. For an insurer, that directly hits your claims. And crucially, your profit margins get squeezed.
It's like their cost of goods sold just shot up without warning.
That's a good analogy, yeah. It strikes right at the heart of their profitability. And investors see that, and they get worried, deeply concerned about earnings.
Okay, so rising costs. What else?
Second, the company faced a pretty significant increase in government scrutiny, specifically around reimbursements.
Regulatory risk.
Big time. And it wasn't just about following existing rules. It hinted at potential changes down the road that could compress margins even more, basically alter the whole playing field.
That kind of uncertainty is poison for investors, isn't it? Hard to predict the future.
Absolutely. Makes modeling future earnings incredibly difficult if the rules might change. And adding to that risk layer, there were ongoing government investigations.
Into what?
Potential Medicare fraud. Now, even just the allegations of fraud, proven or not, they cast this long, dark shadow.
Right. Legal battles, fines.
Massive fines, potentially, long legal fights, a drain on resources, and of course, a big hit to reputation. Investors hate uncertainty, and they really hate legal uncertainty.
Okay, so costs up, regulators hovering, fraud investigations. What else was in this perfect storm?
Well, on top of those direct hits, there was this broader push in Washington, bipartisan actually,
Right.
to lower drug prices. Now, this is more systemic, right? It impacts the whole healthcare industry.
Yeah, that's been bubbling for a while.
It signals a future where pricing power for providers and by extension insurers like UnitedHealth might be significantly eroded. It's a long-term threat to profitability, makes growth look less certain.
Okay, so a lot of external pressure. Anything internal?
Oh, yes. As if all that wasn't enough. Just when investors were desperate for some clarity,
Yeah.
UnitedHealth pulls its full-year financial outlook.
Oof. Pulled guidance. That's never good.
Never. It just removes that crucial roadmap for future performance, leaves everyone guessing, analysts, shareholders, just darkness.
Wow.
And to compound that, the chief executive steps down.
Seriously. Right in the middle of all this.
Yep. A major leadership transition at the absolute worst possible time, arguably. So no clear financial path, leadership vacuum, immense uncertainty.
I get it. You can absolutely see why investors might have been, as you said, running for the hills.
It looked bad, really bad.
Like a company just drowning in bad news, no clear lifeline, cost pressures, regulatory threats,
Grinnell chaos.
the whole 9 yards.
But that's exactly where the story takes this dramatic turn, doesn't it? Because as the stock is plummeting, hitting lows it hadn't seen in ages.
Right when the panic is peaking.
Warren Buffett's Berkshire Hathaway steps in. And it seems, on the surface at least, completely counterintuitive, almost audacious. Definitely against the grain at that moment.
Okay, so here's where it gets really interesting. While everyone else on Wall Street is frantically hitting sell, basically fleeing this perceived disaster,
The herd is running one way.
Warren Buffett, arguably the best value investor ever, does the exact opposite.
He runs towards the fire.
And he didn't just dip his toe in, right? This was a substantial buy.
No, it was significant. 5.04 million shares, valued at, $1.57 billion as of the end of June?
$1.57 billion. It's not a small bet. It's a serious commitment. So what makes this so distinctively Buffett play? It just flies in the face of chasing momentum, doesn't it?
It absolutely does. And connecting this to the bigger picture, it really exemplifies what seasoned market watchers, folks like Mike O'Rourke at Jones Trading.
A known Buffett watcher, yeah.
Right. What they call a classic Buffett move. It's fundamentally about moving towards a stock when Wall Street is stampeding away, running from it in panic.
But there's a key distinction, isn't there? It's not just buying any cheap stock.
Exactly. That's the common misconception about value investing. It's not just about finding something beaten down. As O'Rourke carefully put it, Buffett looks for high-quality companies that look like they are damaged goods.
Okay, look like damaged goods. That distinction is crucial.
Absolutely crucial. Think about it. A company whose whole business model is collapsing, like blockbuster-facing Netflix.
Right, permanent damage.
That's permanent damage. Its core business is eroding away. But a company like UnitedHealth, yes, it's facing a temporary cost surge, more regulation, a leadership change.
But people still need health insurance.
Exactly. It provides an essential service, enduring demand. Its core business is still intact, even with these temporary headwinds. That's a high-quality company that just looks like damaged goods.
So it's discerning temporary, fixable problems from those fundamental, maybe fatal flaws.
Precisely. Flaws that would permanently impair its earning power. That's the key judgment call.
And UnitedHealth, despite all the negative headlines, it's undeniably a blue chip, right?
Oh, absolutely. Being in the Dow Jones Industrial Average for 13 years, that's not just trivia.
No.
It underlines its long-standing stability, its market importance, its status. It's one of America's most significant corporations, part of that elite group of 30 leaders.
And it fits his pattern, doesn't it? This is the 6th Dow stock Berkshire owns now.
That's right, 6th.
Yeah.
It just cements his preference for these established, robust companies, even when they hit a rough patch. He's looking for that economic moat.
That sustainable advantage.
Yeah, something protecting its long-term profits. Brand, network effects, cost advantages. UnitedHealth, with its huge scale and indispensable role, it fits that bill despite the recent noise.
And there's the dividend aspect too, right? Buffett likes his dividends.
He does. He values businesses that generate strong cash flow and return some of that to shareholders. It often signals financial health, disciplined management.
And UnitedHealth's yield was?
At current prices, the yield is about 2.91%. Now, compare that. The S&P 500's implied yield is only around 1.21%.
Wow, more than double.
Substantially higher. That regular income stream, it provides a buffer for long-term holders, gives you a return even if the stock price is bouncing around, and it reflects underlying health, even with external pressures.
It's a sign the company's still making money and willing to share it. Confidence from management.
Exactly. Buffett sees that as a positive signal, and the market's reaction, it was immediate and pretty telling about the Buffett effect.
What happened?
The stock shot up 12% that Friday, closed at $304.01, instantly became the S&P 500's top performer for the day.
12% in one day.
Yep. Biggest one-day gain since March 2020, which was another crazy volatile time. It just shows how powerful that endorsement from Buffett can be.
The Oracle of Omaha speaks, and the market listens.
Pretty much. It sends ripples everywhere, makes other investors rethink their bearish stance, triggers a rapid reevaluation. It's just a testament to his influence, the trust in his long-term view.
Incredible. A single investor moving a whole sector, essentially. Okay, so it's one thing to buy when others sell, but how does he arrive at that decision? It can't just be the low price or the dividend. There has to be like a deeper conviction, some rigorous analysis involved. It's not just gut feeling, is it?
Oh, absolutely not. It's far more nuanced. The crucial next step is understanding the unique insights, the frameworks he uses. How does he see value where others just see distress?
Yeah.
His strategy involves several key things that go way beyond just looking at PE ratios. It's about the intrinsic nature of the business.
Okay. Like what?
Well, first, one of his core tenets, something he's hammered home for decades, invest only in businesses you truly understand.
The circle of competence.
Exactly. He avoids stuff where he doesn't grasp the economics or the competition. And with UnitedHealth, his understanding of insurance isn't just academic, it's deeply rooted in Berkshire's own operations.
Because Berkshire owns a ton of insurance companies, right?
A vast array. Think about it. Jayaco, a giant in auto. U.S. Liability Insurance Group, Berkshire Hathaway Direct. Plus, healthcare liability insurers like MedPro Group, MLMIC.
So he has this internal expertise, an insider's view almost.
Pretty much. Direct, hands-on experience across different parts of the insurance world. He gets the complexities, underwriting, risk assessment, claims, regulations, cost trends in a way most general investors just can't.
That lets them judge the temporary versus permanent thing much better.
With the level of confidence most don't have.
Yeah.
And building on that understanding, Mike O'Rourke pointed out something else.
What's that?
Buffett gets the long-term cycles in insurance pricing. He knows that while UnitedHealth looked like it lost pricing power recently.
With the cost surge and scrutiny?
Right. But Buffett operates with the conviction that, quote, eventually insurance rates sort themselves out.
Ah, the long view again. Believing the market dynamics will correct.
Exactly. Combined with the fact that healthcare is essential, non-discretionary, he believes it'll return to favorable pricing. He's not looking at this quarter's headlines or political noise.
He's projecting years out.
Decades, maybe.
Yeah.
Anticipating those inevitable adjustments in mature, essential industries. That patience lets him look past the short-term static, trusting the fundamental value will win out.
So it's not just today's PE, but what he thinks they'll earn way down the road. Okay, but beyond that deep understanding and long view, were there any actual signs UnitedHealth itself was stabilizing, even as the market panicked?
Yes, absolutely. There were tangible signs, which would definitely appeal to Buffett's analytical side. Remember, they pulled their guidance.
Yeah, created that vacuum.
Well, significantly, they reinstated guidance in July.
Oh, okay.
Now, true, the new guidance was, quote, well below what Wall Street was expecting, so the number itself wasn't great.
But the fact they could give guidance was key.
That's the crucial part. It suggests the company might be, quote, getting a handle on the situation. It signals a move towards predictability.
Even if conservative numbers.
Right. It implies management is regaining control, has a clearer view of the future. That's a huge comfort for a long-term investor like Buffett. It suggests maybe the worst of the uncertainty is passing. They're stabilizing things.
Makes sense.
Okay.
So qualitative signs of stability. What about the numbers, the valuation metrics?
Yep. Beyond the qualitative stuff, there were clear quantitative signs of undervaluation. An analysis by MarketWatch's Phil Van Dorn showed something interesting.
Which was?
UnitedHealth's price-to-earnings ratio, the PE.
Stock price divided by expected earnings per share.
Right. How much you pay for $1 of earnings. It was at 90% of its 5-year average.
So cheaper than it had been historically relative to its earnings.
Exactly. Trading at a discount compared to its own recent history.
Well,
Getting $1 of UNH earnings cheaper than usual. That kind of discount on a high-quality company
Especially an essential service provider.
is exactly what a value investor like Buffett looks for. It provides that margin of safety, like finding a premium brand on sale, quality's still there, price is just temporarily down.
Gotcha. And what about the size of the investment? You mentioned it was big, but in context.
Right, context is important here too. That $1.57 billion stake, while it sounds huge, and it is,
Yeah.
it represented only 0.6% of Berkshire's total equity holdings as of June 30th, which were worth a staggering $257.52 billion.
Wow. Only 0.6%.
Yeah, so Michael characterized this as Buffett just nibbling on the stock.
Nibbling. With over $1 billion.
Well, for Berkshire, yeah, it implies he wasn't necessarily trying to perfectly time the bottom.
He knows that's impossible, right?
A fool's errand, as they say. Buffett's known to start buying and allow for more negative headlines, maybe even further price drops. He could very well have kept buying as it fell more.
And did it fall more after his reported purchase?
It did, actually. The market proved the point. The shares hit a 5-year low of $237.77 on August 1st.
Lower than where he likely bought initially around the end of June.
Significantly lower. Remember, the $1.57 billion valuation was based on the June 30th price, which was around $304. So, yeah, it dropped further.
And where is it now relative to that?
Well, it's run up a good 27.9% from that August 1st low, which is impressive. But it's still actually about 2.6% below where it closed on June 30th, the date tied to Buffett's initial disclosure.
So still slightly underwater from that first nibble, potentially?
Potentially. It just reinforces the idea. This is a long-term play, not a quick flip. He buys quality when it's out of favor, expects it might go lower, and plans to hold for years, letting the true value emerge over time.
Patience and discipline. Qualities often missing today.
You said it.
Okay, so Buffett's move definitely shone a spotlight back on UnitedHealth, validated its underlying strengths for many who'd fled. But what about the ripple effect? What did it mean for the whole healthcare sector?
Yeah, that's a great question.
Is this a signal that the broader industry, often seen as defensive but recently out of favor, is maybe ripe for a rebound? Or at least worth a closer look?
Well, what's fascinating is that Buffett's interest, plus the fact other big names were also buying UNH in Q2, it did spark broader buying across the sector.
Ah, so it wasn't just UnitedHealth that popped.
No. It raises that interesting question. How can one influential investor basically act as a bellwether, signaling opportunities for a whole industry that maybe got unfairly punished by short-term worries?
His move was like hitting a market-wide rethink button for healthcare.
That's a good way to put it. And consider this. Healthcare had actually been the worst performing sector in the S&P 500 this year.
Worst performer. Wow. Usually seen as stable.
Right. That would normally scare investors off. But a recent JP Morgan note pointed out this really compelling shift in its valuation, something that aligns perfectly with Buffett's approach.
What shift?
Historically, healthcare often traded at a premium to the S&P 500, reflecting that stability, recession resistance, growth.
Okay.
But JP Morgan highlighted that while it hasn't traded at a premium since the early 2000s, it now trades at a substantial discount to the S&P 500.
A discount. That's huge.
It's a crucial data point, suggests potential undervaluation right across the board. You might get these robust, essential businesses cheaper relative to earnings than the overall market.
Right.
That discount, plus Buffett's move, very intriguing for value investors.
That's a powerful signal. A sector historically premium, now at a discount. But are there fundamentals supporting a better outlook? Beyond just valuation?
Absolutely. Beyond valuation, there's strong underlying data suggesting the actual business of healthcare is robust and growing, despite those headwinds we talked about.
Like what?
Take the latest government jobs data. The overall labor market was slowing.
Yeah, I remember that report.
But buried in there was a striking detail. Almost all the new jobs created came from the healthcare industry.
Really? All of them?
Practically. And it wasn't a one-off blip. Sources noted healthcare job growth has been strong for months, sustained significant growth in employment.
What does that imply?
It directly implies increasing demand for healthcare services, which ultimately benefits insurers, providers, everyone in the chain. It's a strong macro sign that underlying demand is very strong, regardless of temporary cost or regulatory stuff.
People always need healthcare.
Pretty much, yeah. Regardless of the economy.
And the market reaction to Buffett's signal? Beyond UNH itself?
Undeniable and swift. The day the news broke, the main healthcare ETF, XLV, that tracks the whole sector, gained a solid 1.7%. And healthcare was the S&P 500's best performing sector that day.
Wow. So investors definitely paid attention.
Oh, yeah. His actions are seen as more than just liking one company. It's often read as a broader vote of confidence in the industry's fundamentals. It prompts that reevaluation, pushes capital back in. Perception shifts fast when Berkshire moves.
And did the peers, the other managed care companies, also benefit?
They sure did. The ripple effect wasn't just UnitedHealth. Its managed care competitors saw significant bumps, too, reflect that broader positive vibe.
Like who?
For example, Centene, ticker CNC, climbed an impressive 5.8%.
Nice jump.
Elevance Health, ELV, rose 4.8%. Molina Healthcare, MOH, shares advanced 4.9%.
So significant one-day gains across the board.
Yeah, indicating a sector-wide re-rating after Buffett's signal. Investors figured, hey, if the leader UNH is undervalued, maybe its competitors, facing similar dynamics, are too. Sparked that broader value hunt.
And did the valuation support that? Were the peers also looking cheap?
Van Doren's analysis looked at that too, found similar trends relative to their own histories, reinforcing that idea of a sector-wide discount.
Okay.
Centene's PE was at 89% of its 5-year average, very close to UNH's 90%.
Right.
Elevance's PE was at 88% of its average, also a significant discount. And interestingly, Molina's PV was way down at just 56% of its 5-year average.
Wow, potentially even cheaper relative to its history.
Potentially, yeah, suggesting maybe deeper undervaluation there. Now, dividend-wise, Elevance had a decent yield, 2.21%, still attractive for income folks.
But Centene and Molina?
They don't currently pay a dividend. So it gives you, the listener, this broader perspective, right? Where value and yield might be found within managed care. Lets you look based on your own goals, income, growth, or both.
What a fantastic deep dive. We've really unpacked how Buffett's move into UnitedHealth wasn't just random.
Not at all.
It was this meticulously calculated play, totally consistent with his long-standing value principles. Such a powerful lesson in spotting quality under temporary pressure.
Leveraging that deep industry knowledge.
Seeing beyond the scary headlines and just having that incredible patience to wait for the market to catch up.
Yeah, wait for intrinsic value to be recognized.
It really shows that sometimes the best opportunities pop up precisely when everyone else is heading for the exits.
Absolutely. And connecting it to the bigger picture, it just underscores how vital critical thinking and independent analysis are, especially today with information overload and narratives driving things so fast. Instead of just reacting to panic, following the herd, Buffett's move encourages you to look for the why. Why is the market uncomfortable? Where is the underlying enduring value?
Look beyond the sensational headlines.
Exactly. Consider the deeper fundamentals of a company or a whole sector. It's a real lesson in independent thought, cultivating that truly long-term perspective.
So what does this all mean for you listening in, whether you're an active investor or just want to be smarter about the financial world?
Yeah, the takeaway.
It's this profound reminder, isn't it? Yeah. Even in really choppy markets, opportunities are out there. But you need to be able to tell the difference. Between fundamentally damaged goods, those high-quality companies facing temporary setbacks, and the truly damaged companies, the ones losing their edge, maybe in irreversible decline.
That discernment is everything.
It's about having the discipline to step in when others step out, provided, of course, you've done your homework like Buffett clearly did here.
Right. And that raises an important question, maybe something for you to think about as you look at markets and news yourself.
Okay.
Beyond healthcare, are there other sectors, other companies that are currently out of favor with Wall Street? Ones that might fit that Buffett criteria? High-quality companies that look like damaged goods.
Interesting thought.
What specific metrics, what qualitative factors would you use to try and identify them? How would you distinguish them from businesses facing permanent, insurmountable problems? Food for thought.
Definitely something to mull over. And that's our deep dive for today. We really hope you feel more informed, maybe even a bit inspired to look at your own sources, your own potential investments with a fresh, more discerning eye.
Hope it was useful.
We'll catch you on the next deep dive.